Hello, my name is Elliott. I'm the editor of Personal Finance. I'm also editor of The Energy Strategist and co-editor of MLP Profits with Roger Conrad. Today I want to talk a little bit about more the trading side of what's going on in the market right now, in the S&P 500 in particular. As many of you know, I tend to focus more on fundamentals, longer-term growth prospects for companies and sectors and economies. But especially in markets like this where you're seeing very fast selling, you're seeing a very volatile market ever since the market really topped out in late April. One of the things you have to look at is really the charts and what's going on in terms of support and resistance and trends in the broader markets. And what we're really seeing right now is the S&P 500 trading around some key support levels. The first, of course, being 1100. The S&P 500 has breached that level. Now 1100 is important because that's about where the 200-day moving average on the S&P is. Now, kind of sounds like voodoo, but if you look at it, take a chart of the S&P, look back about 10 years, overlay a chart of the S&P 500's 200-day moving average, and you'll see that in bear markets, the S&P 500 tends to make lower highs and lower lows underneath that 200-day moving average. When we're in bull market phases, it tends to be above the 200-day moving average. 200-day moving average tends to be rising. Again, it's a very slow indicator of trend, but it's a very good indicator of the overall trend in the market. Since March of 2009, we've really seen the S&P sort of remain above that 200-day. We rallied starting in March, broke above the 200-day a couple months after that, and we've been above it ever since. We have seen a series of corrections. Most of them have stopped at or very close to the 200-day moving average. So that is a key level to watch. Now, it's not uncommon on a normal correction for the market to see it trade under the 200-day, but typically it doesn't stay there for very long, not more than a few weeks or so. But we've seen that level sort of breached. The next level to watch on the S&P 500 is really the February 2010 lows. This is a level that I know is being watched very closely by a lot of the shorter-term traders out there. And that level is around 1044. This is a level that if breached on a closing basis by the S&P, could be a big concern in the sense that you could see some faster selling, probably a break of that 1,000 level on the S&P, which is sort of a key psychological support. 1044 is also pretty important because about 1,100 on the S&P is about a 10% correction. You start getting down below that, you start talking about that 10 to 15% level, which is really the maximum correction or pullback within a bull market that you typically see. So these are very important levels to keep an eye on if the S&P breaches that. A couple other indicators to keep a very close eye on. One is the VIX, which is basically the S&P 500 volatility index. Now this is based on options market trading activity. When volatility expands a lot, indicates a lot of uncertainty and basically fear among traders. The higher the VIX, the higher the fear level, the more the panic. Typically you see spikes in panic, spikes in the VIX around key market lows. Typically the VIX falls when the market's rallying, people don't have a lot of fear. Near important lows, you'll see that VIX really spike. We have seen the VIX spike twice over 40. That's a kind of a key level right now. First in the sort of May 6 flash crash. And again, towards the latter part of May, we saw another spike above that 40 level. This is a key level to watch. As the S&P 500 approaches these technical support levels I just mentioned, in the context of a spiking VIX, this is a time to look for a big turnaround in the market. Now, this could come in the form of a very bad day for the S&P, where the S&P trades down considerably and then closes higher on the day, sort of an intraday reversal. This is the kind of thing I would look for around these key technical levels with fear levels so high. Now, what does it mean for the market over the next several months? Well, one of the things I'm looking for is for us to see some sort of a capitulation, some sort of a panic low in the market. Does not mean that the market's going to rally immediately to new highs. What I think we're setting up for is a pattern very similar to what we saw back in 2003 and 2004. 2003 was a big up year for the market. The economy recovering from a recession, the market breaking the back of the bear that had been in place since 2000. We saw the market rally very powerfully into the early part of 2004. In March 2004, the market topped out. over the course of the next several months, we saw the market trade lower, kind of find some stability, and then really remain kind of range-bound with a slight downward drift for several months before breaking higher again in the autumn and trading to new highs in late 2004. Now, what's important to mention is that there were also some fundamental similarities with the current environment. Back then, as now, there was a lot of talk about China slowing down. There was a lot of talk about the U.S. economic recovery stalling. That's the last time we heard the words double dip from a lot of commentators out there. A lot of things that are worrying the market today were also worries back in 2004. Not surprising, we're starting to see some of a similar pattern there. The market in this case rallied from its lows in 2009 all the way up until late April, so it topped out a little later than the 2003-04 cycle. But it topped out in late April, has traded down over 10% correction. I do expect that we'll see somewhat of a similar trading range here unfolding over the course of the summer. Probably this will be a case of the beginnings of some signs of stability in Europe credit markets. This would come in the form of increasing confidence that the EU $1 trillion bailout package will be enough to stabilize the bond markets in those peripheral countries like Greece, Italy, Spain, Portugal, and also increased confidence that some of the austerity packages that we're seeing in countries like Greece won't mean a major slowdown in growth in Europe's core or the United States. So I think we'll start to see some increasing confidence around those issues as we move into the autumn. And then I think we have a very good chance of seeing a break and a rally to new highs, just as we saw back in 2004. So several things to think about there. First of all, in the short term, look at that 1044 to 1050 level as a very key support level. The market should hold that. If it doesn't, we're going to have to reassess and keep an eye on some of those credit metrics in Europe for the potential for a more serious bout of contagion. As long as that holds, I do think we're setting up for a pattern very much like 2004. Situation there, trading range that probably lasts for most of the summer prior to a breakout towards the end of the year. So those are just a few things to watch technically on the more short to intermediate term trading pattern in the S&P. Thank you very much.